So in this question, we have Narwhal Company, and we all know that beautiful little narwhal. I put one off to the right just to give you a little visual of what a narwhal is, and guess what? That's what this company is all about. Now, ultimately, we're going to be focused on what the debit or credit to the direct labor efficiency variance account would be for February of year 3. So overall, big picture, we're going to be looking at direct labor and determining whether they were efficient or not. Now, we're actually going to go through the full journal entry, which means we need to also understand the direct labor rate variance for Narwhal as well. So what we're going to do is calculate both the direct labor efficiency variance as well as the direct labor rate variance, and then come up with the journal entry. So starting with the direct labor efficiency variance, we can see in our two-step approach, the first thing we do is take actual labor hours, which it says was 110 hours, subtract the standard labor hours, which would have been 100 units at 1 unit per hour, so that's 100 hours. So that means the difference in labor hours is 10 hours. And then we multiply by that standard direct labor rate of $15 per hour. That gives us a direct labor efficiency variance of 150. Now it's going to be unfavorable since we incurred more labor hours than what the standard was. So keep that in mind. Now for the direct labor rate variance, well, we focus on the rate. The actual rate was $16 per hour. The budgeted or standard rate was $15 per hour. So that's a difference of $1 on an hourly basis. And then we multiply by actual direct labor hours of 110. And that gets us up to a direct labor rate variance of $110. Now that variance is going to be unfavorable as well, because our actual labor rate was higher than the standard. Now, we don't know why. Maybe they hired, more skilled employees, but either way, it's unfavorable when we compare to the standard. Now, let's come up with the journal entry. So the first thing is to figure out what we would debit to inventory. And because it's labor, we're assuming they made the raw materials into finished goods. Now, this is going to be based on the standard for the inventory account specifically. Right? And that was 100 units at $15 per hour. So specific to labor, that's going to be a debit to inventory finished goods for $1,500. Now just remember that's both based on the standard. Now for the debit, to finish off this side, well, we're going to have a debit to both the direct labor efficiency variance as well as the direct labor rate variance, since they are both unfavorable. Now these will be included in the inventory asset account because, we haven't actually sold this inventory yet. So it's still capitalized. We're just separating out the variances from what the standards were. So when you look at a trial balance, you would clearly see that, both the direct labor efficiency variance and the direct labor rate variance, here's where the numbers, and they are both unfavorable for the period. So on the debit side, well, we have a total of 1,760. And what's the credit? Well, we actually need to credit and put up that liability for the wages that are paid to the employees. And this is going to be based on both the actuals, right? So the actual rate was $16 per hour. The actual hours was 110. So that means total wages payable would be 1,760. So that's how we end up with a balanced journal entry. Right, we need to record the actual amount we need to pay our employees, but then on the debit side, well, we have it broken out between what the standard was, as well as our two direct labor variances, both the efficiency and rate variance. And we can clearly see in our trial balance that both of those were unfavorable. So just going back to what the question was asking about the debit or credit to the direct labor efficiency variance account. Well, that's going to be a debit to direct labor efficiency variance for $150. So that's the correct answer. Now, this is probably taking it a bit further than you'll need to know for the exam, but I really wanted to show you what the journal entries would look like when we combine both types of variances for direct labor. That way we see the big picture, we understand how it would likely be recorded in the company's trial balance, and that will help us round out the process.